All right. Good morning, everyone. We put up the chat there so you can drop a comment in the chat once you pop in here. As always, we'll wait just a couple of minutes to go live on all the different platforms and give everybody a chance to jump on. So hang tight with us here. Hope everyone's been having a great week. Got a great topic for today as well. Good morning, Lee. Checking in there in the chat. All right. Good morning, Matthew. Good morning, everyone jumping on. There we go. Christina, Janet. Good morning, everyone. For those of you that just jumped on, we're just waiting a couple of minutes here to get started. So hang tight. All right, looks like we are good to go. So we'll go ahead and get it started. We can take the chat there off the screen. All right. So welcome, everyone. My name is Kyle Hiersche. I'm the COO of the Mortgage Calculator, joined here by our president, Nick Hiersche, and our sales manager, Jose Gonzalez. We are a correspondent lender that specializes in non-QM loans. Now, today, like every day, we're going to go ahead and go through the live rates of different programs here today to see what the rates are doing, to see how the market is today. And then we're going to do a deep dive into a topic like we do every day. And today's deep dive is going to be ground up construction loans. So yesterday, we went over the one-time close, which is for primary residences. And today, we're going to go over ground up construction for investments. So we'll have Jose do a deep dive into that, and he has some quotes pulled up as well for ground up construction loans. But first, like we do every morning, Nick, let's go ahead and pull up the pricing tool and go through the actual rates for today.
All right, so let me go ahead and change my screen and we will get started. So as Kyle mentioned, this is, let me change this so I'm on the side. This is our live pricing tool. This is just for our team of mortgage professionals. We have over 300 loan officers licensed in 22 states for primary and second homes, and we can do our business purpose DSCR and our topic today, our investor ground up construction and fix and flips in pretty much all states, since those are commercial loans. So we will just check out the pricing for today. If you'd like a full loan estimate, please get with our team members. This tool will just show us the pricing and the APR. For today, it is March 30th, just after 11 a.m. Eastern. So this is the rates for today. For all of our examples here, we'll set up a basic scenario, 400,000 loan amount, 80% loan to value. That means 20% down payment. Tell the computer to find the best rate at 99 price. That means one discount point. Most of our borrowers are asking to buy down the rate a little bit. So this is the typical request. We will do our 3 scenarios that we do every morning. We'll do our conforming conventional programs. Then we'll switch over to our FHA programs. And then we'll go into our expanded guidelines, aka non-QM, where we have over 5,000 alternative loan programs that use alternative documentation. For VA, that's only for our eligible vets. So if you are eligible, please get with us. We'd be happy to quote it. But since not everybody is eligible, we don't do that live. And same with USDA, must be in a rural USDA area to be eligible for USDA loan. If you happen to be shopping in that area, please let us know. We'd be happy to quote it up. So we'll start with our first example, conforming. We'll set everything to the same scenario, a purchase, 30-year fixed loan, standard loan, primary occupancy, single family home, 1 unit, state of Florida, County of Miami-Dade, that's where our office is. And we will use a estimated FICO of 760 for these estimates and an estimated debt to income ratio of 40. So with all those settings, let's check out our conventional rates this morning. And not much has changed. So exactly the same from the show yesterday. Rates dropped a little bit in the afternoon, I believe, but now we're back to what they were exactly on yesterday's show. So 6.5 rate here, 6.5, for 1 discount point in cost for a final APR of 6.676. So a great option here for our borrowers that qualify for conforming, and we love to see these rates go down. They've been in the 7s recently. Now we're back in the 6s. Everybody's happy. Now let's go back to our pricer and check out our FHA rates. So we'll set up the same exact scenario. And for any reason our borrower doesn't qualify for conforming conventional, usually the second option is FHA, which just allows us to expand the guidelines a little bit with a little bit more leniency on credit and a higher debt to income ratio we can use. So this is typically the next option. We'll set everything else exactly the same. And let's check out our FHA rates this morning. Again, I think this is about the same as it was yesterday morning, almost exactly. So 5.625 rate for 1 discount point in cost and a final APR of 6.227. So remember, always compare the APR so we can compare across the programs. And even though FHA does have an upfront mortgage insurance and a yearly mortgage insurance, it's actually cheaper overall in this scenario for this typical borrower. So always a great option to compare FHA with the conventional options. And in this case, you can actually get it for a little bit cheaper, low 6s. Remember, the APR for the conventional was in the high 6s there. And now let's go into our final demo for our primary home. And we're going to set up the same scenario. And at many other banks and lenders, they don't have any other options really besides conforming and FHA. Fortunately, here at the Mortgage Calculator, we specialize in non-QM, which is this option here, expanded guidelines, where we have over 5,000 programs beyond FHA and conventional. So we'll keep everything else the same, but one new option has popped up, and that's our income verification. So typically, we're going to go to a non-QM program to use alternative income documentation. So let me scroll down a little bit here. So full doc is obviously what we use for conventional FHA. That's 2 years of tax returns, what everybody's used to. But when we switch to non-QM, we can use alternative methods. So we can use 1 year alt doc, 2 year alt doc. We can use assets. We can use our business bank statements. We can do our DSCR loans we'll talk about in a minute. And our most popular program by far for a non-QM program is going to be our personal bank statement, 12 months. And that's for our typical self-employed borrower. Many of our self-employed borrowers have various write-offs on their tax return. So 2 years of tax return often results in less income than they would hope for. So in this case, we're going to use a non-QM program to get 12 months of their bank statements to determine a debt to income ratio, in this example of 40, using their bank statements and their actual cash and expenses in the bank rather than their tax return. So typically for most self-employed borrowers, they are able to qualify with much more income using this method and therefore qualify for a much larger house or much larger payment. So a customer that maybe not qualify at all with another program can now qualify, or a customer that needs to qualify for more loan amount or more home can now qualify using those alternative income documentation methods. So this is our most popular non-QM program. Let's check out the rates this morning for bank statements. Remember, non-QM is always going to be a little bit higher rate because this is for someone who would, again, not otherwise qualify. But the top option here, again, same as yesterday, so rates are down. This is good. 7.375, very reasonable compared to the conventional, and 1 discount point in cost for a final APR of 7.422. So very comparable there. You saw the conventional was in the high 6s, the FHA was in the low 6s, and here you see the bank statement option, which is a great option in the low 7s. So very comparable for all 3 options. We would love to give all of our borrowers all 3 options so that we can find the best program that fits them. Now, if I scroll down here, there's dozens and dozens of different programs here under bank statements. So please get with our team. Some of these ones in the higher rates may allow things like a credit event, like a bankruptcy or a foreclosure. So there are just tons of different options here. This is why we love these non-QM programs. Please get with our team, and we'd be happy to find the best for you. Now, before we pass it over to Jose for a deep dive, we always want to do our live rates for investment properties. So our final 2 examples here will be for an investment property purchase. So whether our investors are seasoned investors with dozens of properties, or this is a first-time investment property purchase, we love to work with anybody looking to get investment properties. That's really where we specialize, and that's really where the non-QM programs have a lot of opportunity. So let's set up our final 2 scenarios here. We'll do an 80% LTV, same as before, 20% down payment. Everything else will be set the same. and we'll compare our conforming conventional investment properties that everybody's used to, conventional investment property loans, with our expanded guidelines programs, our non-QM. Remember, FHA, VA, USDA are not eligible for investment properties, so we'll simply compare these two options. So we'll set this to conforming. Everything else will stay the same as all our other scenarios, and let's check out our investment property rates. So you see here some decent rates in the sixes still. So 6.875 is the best combo the computer found. But you see here high discount points. So under the conventional programs, they've added loan level price adjustments, aka fees, for investment properties. So unfortunately, the computer's not able to find a rate with one discount point in cost. So the best combo it found here with the lowest APR is 6.875 rate for 3.5 discount points, which is in this example $14,000. That's a lot of money. So many times our investors would like other options. They don't mind a higher rate if they can save some of this money out of pocket. So even though this has a great APR of 7.135, it does cost a little bit out of pocket. So we love to compare our non-QM options in order to solve that problem. So for our final demo here, we'll set everything else the same. We'll switch to investment property and under non-QM expanded guidelines. So now for a non-QM investment property, we have two new options. First, we set our income verification. And our most popular option by far is our DSCR program because it doesn't require any employment or income verification from the borrower. Simply going to use the estimated rental income from the property in order to cover the mortgage expense, the PITIA, for this mortgage we're quoting right here. So we have tons of options for a DSCR ratio of greater than 1, where the gross rents will cover the expenses. And there's even options for a DSCR ratio lower than 1. So even if the property doesn't quite cash flow. So dozens of different options here under this umbrella. Please get with our team to find the one that fits your scenario. Now, the final option we have to select is a prepayment penalty that is standard on a non-QM investment property. So we're going to price ours with 3 years, which is pretty standard. We could select 0. That will limit our loan programs and cost more money. And we could select 5, which will limit our loan programs because it's less common and will save us a little bit of money. But the most common option is 3 years. So that's what we always use for our demo here today. So let's check out our DSCR rates this morning. We love it when we can see the DSCR rates in the 7s. The other day they were a couple options in the 7s, but here we still have a great option, 7.99% rate for 0.6 in discount points for a final APR of 8.024. So just a little bit higher on the APR, but you see here our investors are happy, whereas before they had to pay $14,000 cash out of pocket here for these discount points. Now we've lowered that to $2,400. So our investor can deploy that cash in other investment properties, maybe rehabs, whatever they're doing. So this is typically what we love to present is our customers that qualify for conventional. We love to quote that as well, but we really recommend to compare some of these DSCR options. DSCR has a lot of benefits because it requires no employment or income. Most of our investors that have multiple properties will start multiple loans at the same time, do some cash out refis on a couple properties, 1 or 2 properties maybe, and then use that to buy a couple more properties. And we can have all those loans going at the same time because they're DSCR loans. They don't require employment or income verification for the borrower. And if you scroll down here, you notice we have dozens and dozens of options with different DSCR ratios. As I mentioned, this one has a higher rate, but notice it has a ratio under 1. So this is for a property that doesn't quite cash flow, still gets some amazing rates. So dozens of different options here under DSCR. Please get with our team. We would love to quote all of these that fit your scenario. So now that we are done with the live rates, let's go into the detailed example. So give me 1 second and let me introduce our topic for today, and then I'll have Jose take over. Let me change my screen. All right. So the topic for today is going to be ground up construction loans. So yesterday, remember we did one-time close, which is our conventional VA, USDA, all of those options under one-time close, where a primary borrower for a primary home or second home will purchase a lot, get a plan, right? Architect, full plans to build a home, and then we'll do a loan for the lot purchase, the entire home, all of that. That is a one-time close construction loan. What we're talking about today is totally different. This is ground up construction for investors. So this is for investors, fix and flippers that want to buy a lot and build an entire house from the ground up. So this is for investment property. This is for speculation. This is for developers This is not for primary homes for one-time close, which we did yesterday. So please check out yesterday's episode if you're looking for a primary build. Today's episode's all about our investors. So I'll go ahead and pass it over to Jose, our 27-year veteran, who can talk about the ins and outs of the investment property ground-up construction loans. So go ahead, Jose.
Good morning, everybody. Thank you for joining us for Daily Rates Live with the Mortgage Calculator. Yes, like Nick was mentioning, yesterday is for primary, second homes only. Today is investment or otherwise known as spec homes, which is a home being built to sell for a profit, right? Ground up construction can be tricky because there is a certain experience level requirements for ground up construction. The experience level requirements we're talking about for ground up construction are similar as to when we were talking about fix and flip rehab loans. They are experience requirements of the owner of the flip tractor and the owner of the deal. All of that is subject to review and approval by the lender. But it is something that definitely has to be taken into consideration when sizing up the deal to see which is the best option. We do have options for zero experience ground up construction. So do not fret if your investor, if this is their first project. We do have options so that they can break the ice on it, and then the next one maybe get a little bit more favorable rate, but it's not a big difference. It's about getting the deal.
They got to start somewhere, right, Jose? We gotta start them somewhere.
Yeah, we're not gonna put them in a situation where telling them, "Oh, go get a JV partner that has experience," and now all of a sudden you're cutting your profit by 50% because that JV partner is going to be the one that's going to be, guaranteeing the deal. So nobody's going to put their guarantee up there for a nominal fee. So in this manner, we can provide the solution, which is you don't need a JV partner if you don't have experience. So, but the one that we're going over now is going to require at least an experience level of 1. But they're very important to note here, experience does not constitute ground up construction experience. In this particular option, after reading into the guidelines, experience is actually it could be ground up construction experience, it could be heavy rehab experience, or it could actually be investment units owned experience. So read into the guidelines. Don't assume what they're talking about when they're talking about experience. Okay. So I have multiple examples here of experience level, right? So I got one here, middle of the road with 5 units of experience level. This is a deal where the purchase price of the lot is $150,000. So that's the as-is value of the lot as well. The renovation is $275,000. That includes $250 in actual build, $25,000 in soft costs. They do let us also build in the interest reserve. So in this case, I've selected an 18-month term. 12 is the shortest, 24 is the longest. So, I'm going at 18 months. Then to break it down here, you see that they're lending the borrower 45.74 of the after repaired value here. And now keep in mind, this also includes the purchase of the lot, which is, this doesn't mean that you have to own the lot already. If you own the lot already, then we would be doing this as a refinance. It would be different because now you're contributing equity when it's a refi. This case here, the more common scenario here is a purchase, so that's how we're doing it. So we're including the purchase of the lot. So they're going to give this borrower $361,250 is the total. But here we can break it down a little bit more. So you see how they're calculating it. This is the out of pocket for this deal on the day of closing. So, you have your down payment, you have origination, closing costs. Mind you, this doesn't include, some of the title fees and all that. This is just some system generated items with the lender fees and stuff. So total estimated cost of $100,163. They have a contingency reserve of 10% of the loan amount. If that's for cost overruns, change orders that could come along the way. If that doesn't get used up, obviously whatever is left over will get returned to the borrower. And then, so we have a total estimated liquidity requirements. In other words, what they have to have available, $136,288 for purchasing the lot and all of the construction funding and everything else that has to come into play there, right? So again, I'll just let you look over these numbers a minute. It's quite a long list. I couldn't put it all on the screen. So you got initial advance, and then initial advance, and then you got to do draws. Keep that in mind. That's all subject to whatever the scenario is. And then in this case here, the rate, 11.06%, right? So, and I'm going to show you some examples now where all I'm going to change is the experience level of the borrower. And also in the last case, I'm going to change the ARV just so you can see the differences. So this one, experience level, is 5 units, and the ARV is $675,000. Now, this example here, now I went to the extreme, 1 unit experience level, same deal, $150,000 purchase price of the lot, $150,000 as is value of the lot, $250 in hard costs, $25 in soft costs, right? Everything the same. ARV is $675. So you'll note loan amount changed a little bit, right? Loan amount changed to $350,625 versus $361,250. So not a really big difference there, roughly $10,000, $11,000, because the deal still has some good profit. Because mind you, if we're $275, $379, we're at $425. What is costing him, plus closing costs, and we're saying $675. So that's a nice hefty gross profit margin there, which is what they're really looking at, right? So here, even with 1 unit experience level, the deal has so much meat on the bones that they're willing to take it. They're only going to drop, roughly $10,000 off of the loan, but still look at the loan to value, and that's the finished value, 37.86. So like, yeah, we'll take it. And then your estimated liquidity requirements, 146,541. I think the other one, that difference should be only the 10,000, so 136,282. So this is 1 unit. Now I'm going to show you the opposite end of the spectrum, 10 unit, same deal, just 10 units, right? And now we get $382,500 in loan amount. So gets a little bit better. Here, this one, I also dropped the value a little bit to see, because you see now our loan to value is 60.18%, and it still gave me a good deal there. So total estimated liquidity requirement, $117,000. You see it got considerably better when we have our 10 units of experience versus 1 unit. So now I'm putting here a $550,000 ARV for the 10 units. Actually, now we're at 71.67. And the other one I had put 575. So this one I put 550. And so it's still giving us the same loan amount. It likes our borrower with the experience level. It likes the profit on the deal. And again, we come down here and it's $117,000 for the total liquidity requirement for the borrower. And then I cut it even a little bit more to see. So I'm like, okay. And you can all play with these scenarios and the different pricing engines and see where you can take it, right? Again, we're on our 18-month loan term, and the loan amount is reduced here a little bit, 375,000. So again, we're getting good monies here. Total liquidity requirement 124,000, and remember that includes $37,500 in a contingency reserve, which if it's not used, that gets returned to the borrower, and they'd be in the deal for like $90,000, which would include purchasing of the lot and would include their portion of the contribution to the deal, closing costs, the funding of the interest reserve. So now you see why the investors love this ground up construction, because otherwise, how else are you going to do this? You're going to have $500,000 just sitting around. So in this case, you're not making a payment; they're funding everything into the deal. You just got to concentrate on building the home. So again, the rate on this one. Did I pass it there a minute? Should be 10.82%. Didn't show up here on this one, but the rate is 10.81% is the rate. So again, very good rates on these deals. Remember, those are interest-only payments as well. So, and it's funded with the loan. So not a lot of expenses there when you consider it, other than, once you're in, just building the home.
All right. We got a couple questions here, Jose. Mostly about experience, which is always, good questions here.
Yeah, they usually
how is the rehab documented? We talk about this all the time. So what is the actual nuts and bolts there?
Okay, they're usually going to require a track record, usually documented on a spreadsheet, Excel spreadsheet, and they're just going to want to see and obviously provide documentation, closing statements showing when, if it's, when the asset was purchased and when the asset was sold and who borrowed the money, right? So you have to prove that you were a participant owner on the deal when it was purchased, that you participated in the rehab, and that you participated in the sale, and that it was all successful, that it made money. That's the key. If you weren't in on the deal when it was purchased, you're not going to get credit for the flip. If all you did was maybe you were a JV partner, you lent money, you contributed some money, but your name wasn't really in the ownership of the property when it was bought and when it was sold, you're not going to get credit for that deal. If you were the contractor on the build, you're not going to get credit for that deal because you built the home, but you didn't actually manage the flip or the build or whatever it was. Now, again, in this particular scenario here, though, now they do go back 3 years on the experience. So
that was the next question here, yeah. Jose.
They go, typically it's 3 years. But again, dig deep into the experience, because when I was scouring the definitions for the options we're looking at today, rather surprised to find that experience counted ownership of investment properties as well.
So just long-term rental properties,
yep.
Regular investment properties are as well. Beautiful.
Mm-hmm.
All right. Well, looks like that's it for the questions. A bunch of comments. Thanks everybody for tuning in. But let's go ahead and wrap it up, Carl.
Yeah, absolutely. So thanks for tuning in. Great thing here today about investments. And remember, yesterday we went over the one-time close, which is for primary residences. So if you weren't able to check that out, definitely check out yesterday's episode. But today was great to look at it from the investor's standpoint. We have over 300 loan officers all across the country. We are licensed to do business in 22 states. Plus, this ground-up construction we can do in almost every state in these investor-type business purpose loans. So if you need to work with a loan officer, if you are an investor, go ahead and visit us at themortgagecalculator.com. We can pair you up with one of our loan officer consultants. And as you can see, this is a process that you're going to need a consultant to walk you through, right? So most loan officers know conventional FHA, USDA, VA, but don't go further along than that. Our loan officers here at the Mortgage Calculator are not only trained in all of that, as well as all of the non-QM, the DSCR like Nick went over, all the way to the investments, ground up construction, fix and flip commercial, and everything in between. So visit us at themortgagecalculator.com. We can pair you up with one of our loan officer consultants. We do this show every single weekday at 11 a.m. Eastern time. So please tune in. We go through the rates every morning and then go do a deep dive into a topic every day, just like we did today with ground up construction. So thank you everybody for tuning in. Thank you, Nick. Thank you, Jose. And we hope to see everybody tomorrow at 11 a.m. Eastern time.
Thanks, everybody.
Thank you, everybody. Have a great day.